We're just showing there the earnings estimates for Q2. That was the actual, actually, I should say, for Q2. Then the earnings estimate for Q3, about 5%. And then it pops back up for Q4. Reading your notes, you're saying that the earnings estimate for this current quarter, Q3, might be a bit low. But I want to ask you, is that a concerning sign for you, or is it kind of raising the possibility for some beats that might lead to big stock gains for investors?
A positive sign for the market, Frank, even though cutting earnings estimates is, theoretically a bad sign for where the economy is. But I think Wall Street has gotten it wrong here. We've seen earnings estimates come down as we've gotten a few bad jobs reports, as we've gotten a growth scare. But at the same time, this corporate America has consistently proven Wall Street wrong. Earnings estimates have been about 4 percentage points lower than what actual earnings have been over the past few quarters. So I'd expect Wall Street to hurdle this bar easily. And I actually think analysts are kind of giving companies, an easy ride to, better earnings and better perception here.
So you're saying that it's a possible, opportunity if you're an investor, because you also gave us this stat that 96% of quarters at the S&P 500 has seen EPS growth. The U.S. economy has also been expanding. So even though the estimate's a bit lower than the other two quarters for Q2 and Q4, isn't that just a bullish sign for the U.S. economy overall that we're expecting earnings growth?
I think so. And you're right, Frank. I mean, pointing that out, earnings are still growing. In fact, we saw a slide in profits last year, and that slide seems to be over, with analysts expecting earnings to grow actually quite strongly in the
Okay.
quarters ahead. So I think all is good on the earnings front right now. I think investors will be skeptical toward the management commentary that we get, because, of course, there are still some pretty obvious worries about a recession going forward. So I think investors are going to
Okay.
be looking toward the C-suite for color on that.
All right, so some concerns about a recession going forward. We're starting to hear more and more people mention that as a possibility. With that in mind, you're saying that right now is time to reallocate your tech holdings. A lot of people have gone to tech for safety. When you say reallocate, what do you mean? Is that outside the Mag 7?
Well, Frank, we're in the business of, helping long-term investors reach their goals, and we're always trying to prepare our clients for what happens next. And obviously, I mean, tech as a sector, especially bigger, more profitable tech, has had a really strong year so far, or at least through the first half of the year. So, we see this gap forming in markets where, tech's performance is quite strong, but the bar is actually quite high for tech. And I think that's a theme to watch in earnings season, with tech earnings expected to grow around 15 to 20% year over year. So we think that's good. Obviously, there's a strong sector story behind tech, but at the same time, we think that it's a point in the market, especially with high rates and slowing growth, that you should be reallocating out of your winners and looking for more value-based opportunities.
All right, you also say you should look for some opportunities in the bond market with the idea that yields are going to go down. We've heard a lot of people talk about money coming out of the money market funds. We actually haven't seen it. We've seen people stand in there, but you're one of the people that believes that yield in money markets is going to go down. The money has to go somewhere else. What part of the bond curve are you going to put money into or tell your clients to put money into?
Yeah, well, the 10 year is at 4% right now. I think we can all agree that that's quite a bit high, especially if we get another few jobs reports that suggest that the job market is weakening and that there's not as much hiring going on. So I'd look toward the middle to the long end of the curve here, Frank. A lot of our clients are looking there as well, especially if you consider that treasuries are the classic recession hedge, and typically you see that recession reaction happen on the long end. But you mentioned cash, cash and money markets. I'm not sure that cash will move anytime soon, especially if the Fed does keep the economy afloat and rate cuts are gradual. There's still a good reason to keep your money in cash. I'm not so sure the obsession with cash is worth it right now. But
Okay.
at the same time, cash is really sticky, especially when growth worries are kind of the worry du jour at the moment.